If you had just $100 to invest today, where would you put it? Would you buy stocks? Try cryptocurrency? Invest in real estate? Or is there a smarter option that most beginners completely overlook? Over the last few years, I've tested multiple investment strategies, watched markets rise and fall, and seen firsthand what happens when small amounts of money are given enough time to grow. So in this video, we're going to compare 5 popular investments that anyone can start from a laptop. We'll score each one using the exact same categories. First, the learning curve. How difficult is it to understand and get started? Second, passive income potential. Can it generate money while you sleep? Third, tax efficiency. Are there any advantages that help you keep more of your gains?
Fourth, risk. How likely are you to lose money, and how volatile is the investment? And finally, results. We'll look at how a hypothetical $100 investment performed over the last 4 years and see which option came out on top. Quick disclaimer before we begin. This video is for educational purposes only and should not be considered financial advice. Always do your own research before investing. Now, let's get started. Number 1. Individual stocks. When you buy a stock, you're buying a small ownership stake in a company. That means if the business grows and becomes more valuable, your investment can grow too. Many people love stock investing because it feels personal. You can invest in companies whose products you use every day. Maybe it's a technology company.
Maybe it's a retail giant. Maybe it's a business you believe will dominate its industry in the future. The upside can be enormous, but so can the risk. For the learning curve, I'm giving individual stocks a high rating. Successful stock investing requires more than guessing which company sounds exciting. You need to understand revenue, profits, debt, cash flow, competition, leadership, and future growth potential. Professional investors spend thousands of hours studying businesses. That doesn't mean beginners can't succeed. It simply means there is a lot to learn. For passive income, I'm giving stocks a good rating. Many companies pay dividends. These are cash payments distributed to shareholders. If you own dividend-paying stocks, money can arrive in your account without you selling anything. Not every company pays dividends, but those that do can create a nice income stream over time. For tax efficiency, this is generally great if you use the right investment accounts available in your country. The details vary depending on where you live, but many regions offer tax-advantaged accounts designed specifically for long-term investing. For risk, this is definitely high. A company can struggle, competition can increase, management can make poor decisions, entire industries can change. Even excellent businesses experience periods where their stock prices fall dramatically. History is filled with examples of once popular companies that eventually disappeared. That doesn't mean stock investing is bad. It simply means concentration creates risk. Now, let's talk performance. Imagine investing $100 into a randomly selected company 4 years ago. Depending on the stock, your results could range from disappointing to absolutely incredible. Some businesses underperformed the market. Others multiplied several times over. That's the reality of stock picking. A few winners often drive the majority of gains. Get those right, and returns can be spectacular. Get them wrong, and your portfolio can suffer. Individual stocks offer tremendous upside, but they require knowledge, discipline, and patience. Number 2. Real estate investment trusts, also known as REITs. Here's the simplest way to think about them. Imagine thousands of investors pooling money together to buy large income-producing properties. Office buildings, apartment complexes, hotels, shopping centers, warehouses. Instead of needing hundreds of thousands of dollars to purchase property yourself, you can own a small slice through a REIT. For the learning curve, I'm giving REITs a moderate rating. They're generally easier to understand than individual stocks, but you still need to learn how different properties generate income. Some focus on apartments. Others focus on industrial warehouses. Some specialize in healthcare facilities. Understanding what you're investing in still matters. For passive income, REITs score very high. Many REITs distribute a large percentage of their earnings to investors. That's one reason income-focused investors often like them. As long as properties remain occupied and rent continues to be collected, investors can receive regular distributions. For tax efficiency, I would rate them as good to great depending on the account structure available in your country. Again, tax rules vary, so always verify current regulations. For risk, I'm giving REITs a medium rating. They're typically more diversified than owning a single property. However, they're still affected by interest rates, economic conditions, and real estate trends. If occupancy drops or property values decline, performance can suffer. Looking at a 4-year period, a $100 investment in a REIT may not produce explosive growth. However, once dividends are included, total returns can become much more attractive. REITs aren't usually about getting rich overnight. They're often about steady income and long-term wealth building. Number 3, cryptocurrency. Now we arrive at the most controversial investment on today's list.
Cryptocurrency. Some people believe it's the future of finance. Others believe it's one of the most speculative assets ever created. The truth probably sits somewhere in the middle. Cryptocurrencies are digital assets that operate using blockchain technology. Unlike traditional currencies, they aren't typically controlled by a central bank. For the learning curve, I'm giving crypto a moderate rating. Buying cryptocurrency has become easier than ever. Understanding it properly is another story. You'll need to learn about wallets, exchanges, private keys, security, blockchain networks, and market cycles. There's a lot more involved than simply pressing the buy button. For passive income, I'm giving crypto a moderate rating. Certain cryptocurrencies offer staking rewards. Some investors participate in lending or other yield-generating activities. However, these opportunities often come with additional risks. For tax efficiency, crypto tends to score lower than many traditional investments. Tax treatment varies significantly across jurisdictions, and record-keeping can become complicated. For risk, this receives a very high rating. Cryptocurrency prices can rise hundreds of %. They can also collapse just as quickly. Extreme volatility is part of the package. If you're investing in crypto, you need to be prepared for large price swings. Now, let's look at performance. If someone invested $100 into Bitcoin 4 years ago, the return would likely have been extraordinary. But here's the important lesson. Most cryptocurrencies are not Bitcoin. Many projects never gain traction. Some disappear entirely. That's why crypto investing requires careful research and strict risk management. The rewards can be enormous, but so can the losses. Number 4, gold. Gold has been trusted as a store of value for thousands of years. Long before modern stock markets existed, people viewed gold as wealth. And despite all the technological advances we've made, that perception remains surprisingly strong. For the learning curve, gold earns a low rating. Investing in gold is relatively straightforward. You can purchase physical gold, such as coins and bars, or you can invest through funds that track the price of gold. For passive income, the score is 0. Gold doesn't generate dividends. It doesn't produce rental income. It doesn't pay interest. Its primary purpose is preserving value. For tax efficiency, I'd rate it as good. The exact treatment depends on the investment vehicle and local tax laws. For risk, gold receives a medium rating. Historically, gold has often performed well during periods of uncertainty. Many investors view it as a defensive asset. However, gold also has limitations. It generally doesn't produce the same long-term growth rates as productive assets like businesses. Looking back over 4 years, a $100 investment in gold would have delivered respectable gains. Not spectacular, not life-changing, but steady. And sometimes steady is exactly what investors need. Number 5, index funds. And finally, we come to what many experts consider the most beginner-friendly investment available: index funds. Instead of trying to find the next winning company, index funds allow you to own hundreds or even thousands of companies simultaneously. One investment, massive diversification. That's the appeal. For the learning curve, I'm giving index funds a low rating. They're incredibly simple to understand. You don't need to analyze individual businesses. You don't need to predict which stock will outperform. You simply buy the market. For passive income, I'll give them a moderate rating. Many companies inside an index funds pay dividends, which can be distributed or automatically reinvested. For tax efficiency, this scores great when held in appropriate investment accounts. For risk, I'm giving index funds a low rating relative to most other investments. Notice I didn't say no risk. Markets still decline, corrections still happen, bear markets still occur. But diversification reduces the damage caused by any single company failing. Historically, broad market index funds have produced strong long-term returns. A $100 investment made 4 years ago would likely have generated impressive growth while requiring very little effort. That's one reason index funds have become the foundation of many successful portfolios. So, what's the final verdict? Individual stocks offer huge upside, but require skill. REITs can provide reliable income. Cryptocurrency offers massive potential rewards, but comes with significant risk.
Gold helps preserve wealth during uncertain times. And index funds provide one of the simplest paths to long-term investing success. The reality is that no single investment is perfect. Each has strengths, each has weaknesses, and each serves a different purpose. The most important lesson isn't choosing the perfect investment. It's getting started. Because even small amounts of money can become surprisingly large given enough time. Investing isn't about becoming rich tomorrow. It's about consistently making smart decisions that compound over years and decades. And the earlier you begin, the more powerful that compounding becomes. So if you only had $100 to invest today, which option would you choose? Let me know in the comments. And if you enjoyed this video, subscribe for more investing and financial freedom content. Thanks for watching, and I'll see you in the next one.